Class is in session. Welcome to Finance University, the only school where the tuition is free and the degree actually pays you back. I'm your Dean of Dollars, and today we're performing a forensic audit on one of the most foundational principles of modern investing, championed by the legendary John Bogle.
All right, let's get right into it. We're kicking things off today with this awesome question from the Bogleheads community over on Reddit. And you know what? It cuts right to the chase. When people say professional stock pickers lose to the market, are they talking about a fair fight? Or are they just looking at amateurs, people FOMOing into meme stocks at the absolute peak? It's a great question, and that's exactly what we're going to find out today. So, here's the game plan for today's lecture. First, we're going to set up this epic battle, the pros versus the people. Then we'll dive into the cold, hard math that nobody on Wall Street wants you to think about. After that, we are going to be busting some of the biggest myths in finance. We'll even take a look at whether AI is the new magic bullet before we finally land on John Bogle's incredibly simple and, frankly, genius blueprint for winning. Let's get started. Okay, first up, let's paint the picture. In one corner, you've got Goliath. This is the multi-trillion-dollar active management industry. We're talking fancy suits, high-rise offices, and armies of analysts staring at spreadsheets till their eyes bleed. And in the other corner, you've got David. That's the everyday investor, armed with nothing more than a simple, dirt-cheap index fund. It sounds like a total mismatch, right? We are about to see why the story is a lot more interesting than that. To really understand why David even has a shot in this fight, we have to talk about a fundamental rule of the market. And look, this isn't some crazy complex financial theory. This is just simple, unavoidable arithmetic. So what you see here is a concept that is so powerful in its simplicity. Before you factor in any costs, investing is a zero-sum game. I mean, think about it. If you take all the investors in the market together, from the biggest hedge fund in the world to your buddy trading on his phone, their combined return has to equal the market's return. It's a closed system. For every single winner, there has to be a loser. It's just math. And this right here, this is the killer. The second you introduce costs, and we're talking management fees, trading commissions, research expenses, the whole shebang, that perfect zero-sum game immediately turns into a loser's game. You see it on the left. Before costs, it's a level playing field. But look at the right. After costs, the average active investor is mathematically guaranteed to underperform the market. The house always takes its cut. Okay, so the math is pretty brutal, right? But hey, these are the pros we're talking about. The so-called geniuses getting paid millions to pick the winners. Surely they can overcome a few little fees. Well, that brings us to the first giant myth we need to bust. Let's just cut through all the marketing hype and ask the question directly. Forget what they say on TV. What does the actual data say? How do these high-priced, actively managed funds really do over a long period of time? Like, say, 10 years? And the results are pretty abysmal. Over a decade, a whopping 72% of U.S. large-cap active funds couldn't even beat their own benchmark. It gets even worse in other categories. But here's the crazy part. This chart, it's actually being nice. It's hiding an even uglier truth. That ugly truth has a name: survivorship bias. It's a sneaky little trick the industry uses. See, when a fund does so terribly that it gets shut down or merged away, it just kind of disappears from the data. Poof, gone. So we're only seeing the results of the funds that survived. It's like judging a singing competition by only listening to the people in the finale and completely ignoring the hundreds who got booed off the stage in the first round. The losers get sent to what's known as the mutual fund graveyard. Okay, now let's look at the real picture. Once you add those dead funds back in, the numbers are just staggering. Suddenly, it's not 72% of large-cap funds that fail, it's 85%. And for emerging markets, a mind-blowing 95% failed to beat the index. That's a 1 in 20 chance of success. Yeah, if you're not seeing flashing red lights and giant downward arrows on your screen right now, you're not paying attention. This is a massive red flag. Okay, I hear you. You're saying, fine, the average fund is terrible, but I'm not average. I'll just be smart and find one of those winning 5% of managers and invest with them. That brings us to our second big myth. The idea that you can just pick a winner based on their past performance. Just look at this table. It's wild. It shows that if you picked a fund that was in the top 20% of performers in one 5-year period, it was almost twice as likely to fall into the bottom 20% in the next 5 years than it was to stay on top. Let that sink in. Chasing last year's winner is like trying to drive a car by looking only in the rearview mirror. It just doesn't work.
So, human managers, let's face it, are pretty bad at this game. But this is the 21st century. What about the new kid on the block? Can artificial intelligence, deep learning, sophisticated algorithms, can it finally do what humans can't and consistently beat the market? And make no mistake, Wall Street is throwing everything they've got at this. Just take a look at the trend line on this graph. Academic research into AI for finance, especially for trying to predict prices, has just gone completely vertical. It's a brand new arms race. But, and you knew there was a but coming, here's the reality check. AI faces some massive hurdles. It's really good at finding patterns in old data, but that leads to something called overfitting, which is basically like creating the perfect strategy for a game that's already over. All that computing power, it ain't free, which brings back our old enemy, high costs. Plus, a lot of these models are black boxes, meaning even their creators don't know why they make certain decisions. It's not a magic bullet. So after all of this, after the brutal math, the failed pros, the AI hype, we end up right back where we started, with the simple, elegant, and powerful wisdom of John Bogle. He looked at this entire system and realized the only winning move was not to play their game at all. And his solution is this beautiful two-step plan. Step 1, stop looking for the needle in the haystack. Just buy the whole haystack. Own the entire market through a broad, low-cost index fund. That way, you are absolutely guaranteed to capture the market's return. And step 2, minimize the drag. The biggest threat to your long-term returns isn't a market crash. It's the slow, silent, relentless drag of fees. Your job is to keep your costs as close to zero as humanly possible. So, at the end of the day, when you strip everything else away, what's the one thing, the single greatest predictor of how your investment is going to perform in the future? It's not the manager's MBA, it's not their secret sauce strategy, and it's definitely not their supercomputer. It's the price tag. It's the cost. Plain and simple. The less money you give away to the financial industry, the more of your own money you actually get to keep. It's that simple. And if you need one last piece of proof, this chart is the knockout punch. It's one of the clearest relationships in all of finance. As you can see, as the fund's costs go up along the bottom axis, its returns go down along the side axis. It's an almost perfect inverse relationship. In investing, you get what you don't pay for. Which brings us to our final exam question. The evidence is all here. The math is crystal clear. So you have to ask yourself, is your strategy set up to play a winner's game, or you simply capture the market's return? Or are you paying a massive premium to play a loser's game, where the odds are mathematically stacked against you from the very beginning? That's the bell for today, folks. If you want your financial degree to keep paying you back, make sure to smash that like button and subscribe to join the student body. To keep the lights on here at the university, check out our affiliate links in the description and the pinned comment. It's the best way to support the channel. Remember, we drop fresh knowledge every Wednesday and Saturday. Class dismissed.